Hello, class. I'm going to try a new angle here. Again, like I said earlier, just kind of experimenting with different ways to produce a video. Hopefully, this will give me a little more control over my laptop keyboard and maybe not be so awkward. But anyway, all right, we'll just try. So, this is our chapter 39, part 3, and we're going to take a look at corporate powers in this particular video. So corporate powers can be broken down into a few different categories. First of all, corporations all have express powers. And where do we find those express powers? We find them in the law, state and federal law. We can look to the articles of incorporation, and we can also look to the corporate documents, corporate bylaws, which outline the operations of a corporation, the voting rights that the shareholders have in a corporation, and also we can look at corporate resolutions, which are decisions made by the board of directors. Additionally, corporations have powers that are implied. Implied powers basically are that a corporation can take any reasonably appropriate action to advance the corporate purpose. So it doesn't have to be stated fully, but as long as it's in line with the corporate purpose, the corporation has power to do it. This takes us now to what's called the ultra vires doctrine. All right, what's an ultra vires act? An ultra vires act can be described as the act of a corporation that has gone beyond its powers. So leaving the corporation without authority, without power to do whatever it is accused of doing. What happens though if there's an ultra vires act? Well, the result is that the shareholders may sue the officers and directors for having gone beyond their authority. The state may seek an injunction or dissolve the corporation. That's pretty severe in action. Sorry, class, I gotta plug my laptop in. All right, and we're gonna just take a look now at a case that illustrates this idea of ultra vires or ultra vires act. We're going into the textbook, and I'm going to call up this case, Armenian Assembly of America. All right, here it is on your screen. You can see it's a case in point 39.5. Let me just read through this with you. All right, 4 men formed a nonprofit corporation to create the Armenian Genocide Museum and Memorial. The bylaws appointed them as trustees, which are similar to corporate directors for life. One of the trustees, Gerard L. Kafashian, all right, became the chair and president of AGM&M. Eventually, the relationship among the trustees deteriorated, though, and Kafashian resigned. All right, the corporation then brought a suit claiming that Kafashian had engaged in numerous ultra vires acts, self-dealing, and mismanagement. Although the bylaws required an 80% affirmative vote of the trustees to take action, Kafashian had taken many actions without the board's approval. He had also entered into contracts for real estate transactions in which he had a personal interest. Because Kafashian had taken actions that exceeded his authority and had failed to follow rules set forth in the bylaws, the court ruled that the corporation could go forward with its suit. All right, so just an illustration how the actions taken exceeded the authority to act, and how this individual did not follow the bylaws. These are considered ultra vires acts. Returning to our PowerPoint. Let's take a look at what's meant by this concept or this idea of piercing the corporate veil. All right. So once we have a corporation formed, which is what I described to you earlier, right? The liabilities are limited to the corporation. Individual shareholders are not going to be personally responsible for their debts or liabilities. we call this a corporate veil that is erected or dropped, okay? That's going to surround the investors, protect them from individual personal liability for the corporation's obligations and debts, all right? The problem becomes, though, if the owners, the officers or directors of the corporation use the corporation to perpetuate a fraud, maybe some other illegal action. The law then, if it's decides to do this, can pierce that veil, tear the veil apart, and access then the wrongdoers who are hiding behind the veil, so to speak. All right. So the wrongdoing owners or the officers or directors will then become liable if the corporate veil is pierced. So logically, the next question is, when would a court pierce the corporate veil? So here are some examples I have in bullet points for you, and then we'll take a look at this case, Doghouse Investments, which is a fairly recent case. I don't think you can quite see it here in this slide, but it was decided in 2014. I'll take you out to the textbook and we can take a look at it. But here just are the bullet points from my PowerPoint slide. All right, if there's a plaintiff, a victim who was tricked or misled into dealing with the corporation rather than the individual, the court would consider piercing the corporate veil. Second bullet point, corporation was created never to make a profit, or it had insufficient capital at the time of its formation to meet its debts and liabilities. All right, that's going to look a little fishy. So the courts then might take that and say, well, we're not going to allow you the protection of limited liability. We're going to pierce the veil because of that. Third bullet point, corporation does not observe corporate formalities. For example, maybe fails to draft a corporate resolution when they're making a decision, when the board of directors is making a decision. All right, that lack of corporate formality may bring about a piercing of the corporate veil. And this is one thing, if you're a corporate form, a corporate entity, and you have lawyers to advise you, they should be on top of this to make sure all of your decisions are formally documented, because they're trying to avoid any of this piercing the corporate veil from taking place. Right? And then the fourth bullet point is when personal and corporate interests get mixed up, they get commingled. And we looked at that in the previous part 2 of chapter 39, where the corporation is not separate any longer from the shareholders. Right? That's a problem. That's actually a very big problem, and it's very likely the court will pierce the corporate veil. All right, a further example of that would be this Doghouse Investments case. I'm going to switch out now to your textbook. I have to click forward. I believe it's here. Here we go. All right, so it's case 39.3 in your textbook. And here's what happened in this case. All right, Doghouse Investments rents property for its dog camp, all right, from this company called Teal Properties, owned by a Jerry Teal, who is its sole shareholder. All right. Now, what happened is that the property was damaged. There was a fire, and I believe it probably had water damage, and so Doghouse Investments couldn't use the property. It was untenantable. All right. And Doghouse did tell the landlord, Jerry, that they could not use it. Jerry said, okay, we're going to get insurance. We have insurance on this, and I'm going to get the payment for it, and then we'll take care of it. All right. But he didn't end up doing anything. He did not restore the property. Doghouse, of course, wants to continue with its business. So it approached the landlord again, and they made an arrangement where Doghouse would do the repairs and get reimbursed. All right. So what happened is that Doghouse did do the repairs. They spent $39,000 repairing. They submitted the invoices for reimbursement to their landlord, Mr. Teal, and Teal did not want to pay. All right. So it ended up Doghouse had to sue the landlord for this reimbursement money for the repairs it had done to the landlord's property. All right. And what happened during the trial is that it became pretty clear, all right, that Mr. Teal had used his company as if it were his individual bank account. All right. So here's just some information from the case. All right. If you saw how I scrolled down a bit. All right. So the trial court found that Teal Properties owns no property, has no assets, and has no cash except that which is deposited by Mr. Jerry Teal when he has the opportunity to do so. That Teal Properties receives rent and immediately pays it out to pay Mr. Teal's financial obligations. That Mr. Teal is the sole shareholder of Teal Properties and owns the corporation, and that Teal Properties has no purpose other than to collect the rent owned by Mr. Teal. So trial court also looked at the operations of Teal Properties and discovered that he doesn't get a salary from Teal Properties, but he uses all its assets, including the flood insurance, in this particular case with Doghouse Investments. All right. Continuing, the Teal Properties pays Mr. Teal's personal expenses and his other obligations, and he really does not deal with it as a separate entity. That's what they mean when they say here that Mr. Teal does not have an arm's length relationship with the corporation. All right. The court said we just don't buy it that there's that when Mr. Teal argued that it was there's no proof that it's a sham corporation. All right. So you can kind of already hear where I'm going with this, right? All of these actions add up for Mr. Teal. And what happened then, in effect, is that it was found that there should not be really a corporate veil there, that Doghouse Investment should be allowed to pierce the veil and recover from Mr. Teal himself individually. Right. Good illustration, a good case to illustrate the point we're trying to learn here. All right, one more problem before I close out this section, part 3 of chapter 39, and this is the reviewing problem. Let me expand the slide. All right, so I have copied now this from your textbook just to make it a little easier. I have to find a better way to handle all these problems in your book, but here is the reviewing problem. At 12:45 a.m. on July 31st, oh, did I miss a page? All right, sorry, class. I turned off the recording momentarily. Let me back up. All right, here. Sorry. This is the first part of the reviewing problem. So William Sharp was the sole shareholder and manager of Chickasaw Club, an S corporation, which is the same as a sub S, meaning that there are a few shareholders and they get a single level of taxation under our tax laws. All right, so it's an S corporation that operated a popular nightclub of the same name in Columbus, Georgia. Sharp maintained a corporate checking account, but he paid the club's employees, suppliers, and entertainers in cash out of the club's proceeds. Sharp owned the property on which the club was located. He rented it to the club, but he made mortgage payments out of the club's proceeds, and he often paid other personal expenses with Chickasaw corporate funds. All right, at 12:45 a.m. on July 31st, 18-year-old Aubrey Lynn Pursley, who was already intoxicated, entered the Chickasaw Club. A city ordinance prohibited individuals under the age of 21 from entering the nightclubs, but Chickasaw employees did not check Pursley's identification to verify her age. Pursley drank more alcohol at Chickasaw and was visibly intoxicated when she left the club at 3 a.m. with a beer in her hand. Shortly afterward, Pursley lost control of her car, struck a tree, and was killed. Joseph Dancause, Pursley's stepfather, filed a tort lawsuit in a Georgia state court against Chickasaw Club, Inc. and William Sharp, seeking damages. So we're going to take the information that we've been learning and we're going to answer the questions associated with this reviewing problem. I have those questions up here on the screen. So number 1, under what theory might the court in this case make an exception to the limited liability of shareholders and hold William Sharp personally liable for the damages? And what factors would be relevant to the court's decision. All right, I'm going to look at my notes here just so I don't miss anything. All right, so what have we been talking about here? We've been talking about piercing the corporate veil. That would be the theory that we would have to use to get at the shareholder behind the Chickasaw Corporation. All right, now, what kind of factors would be relevant? Well, we're going to take a look at how does William Sharp operate Chickasaw Corporation. All right, what did it say in the facts? I can scroll back up a bit, right? It said that he paid some of the expenses, his personal expenses, out of the club proceeds. For example, the mortgage, right? The location, the premises are owned by him individually, and he rents them to the club, but he makes the mortgage payment straight out of the club's proceeds. That's commingling. All right. There are other expenses too, which they did not delineate for us, but there are some other expenses. So though that fact alone is going to cause a court to take a look and say, well, you know, that looks like you are using the corporation as if it's your own like bank account, and why should we give you corporate protection against liability here? So that would be the theory, and those would be the factors that would be relevant to the court's decision here. All right, number 2. Suppose that Chickasaw's articles of incorporation failed to describe the corporation's purpose or management structure as required by state law. Would the court be likely to rule that Sharp is personally liable to Dan-Cause on this basis, and why or why not? All right, what's the term we have for this? When you have a corporation that has a problem with its articles of incorporation, it's missing something as described here. We use the term de jure corporation, right? And how does that work under the law? Well, the court will take a look and see that it's a problem, a defect in the articles, call it a de jure corporation, but what's that really effectively do? It will still allow the court or the law to recognize the corporate status. So it will not be of any help to Mr. Dan-Cause, who's bringing a lawsuit, but it will protect Mr. Sharp, all right, the de jure corporation. All right, number 3. Suppose that the club extended credit to its regular patrons, although neither the Articles of Incorporation nor the corporate bylaws authorize this practice. Would the corporation likely have the power to engage in this activity and explain? All right, what are we looking at here in number 3? We are looking at whether we have an ultra vires act, right? That's the issue that's being brought up here. Does the Chickasaw Club Corporation, does it have power to extend credit? Well, it technically might not. That was not spelled out particularly in their articles. However, we realize that articles very often, very frequently include this very broad statement of purpose for a corporation, and part of a purpose of a corporation is to do anything in advancement of the corporation's purpose. And so extending credit to patrons, that may fall within that authority to do anything as an implied power to do anything that would extend the purpose or advance the purpose of the corporation. So that may not be a fatal problem here, extending credit. All right, and then lastly, number 4, how would the court classify the Chickasaw Club Corporation? Would it be a domestic corporation or a foreign corporation, public or private corporation? Well, it's formed in the state of Georgia. It's operating in the state of Georgia. That makes it a domestic corporation, and it is held by William Sharp. That I believe is the only shareholder, so it would be privately held or is a private corporation. All right. I hope this is a good illustration problem for you to take on some of what we talked about in this part 3. And we're just about done with the chapter. There's one more section to take a look at. I'm going to close out of this part 3, and I'll pick up with part 4.